Now, it may not be everybody's cup of tea to invest in heavy industry, but in a situation where feedstock prices can be passed through, where input prices can be passed through, and you've got a very high fixed cost, many companies in that situation will earn good money. So I think what investors have to think about is inflation. I think I can believe in decoupling, but I think when you begin to think about inflation, you begin to look at even companies listed in America. You don't throw your hands up in horror at the entire U.S. listed sector. Investors in John Deere will be well aware of some of the good things that can happen when you get agricultural inflation coming through. And there'll be many companies like that all over the world which will benefit from inflation or benefit from selling things to China, benefit from China's demand for commodities, which we're seeing already. So the inflation story is a negative one, but I think the crucial difference with the 70s is this. Inflation won't get to such a high level, but also investors have got many, many, many more options than they had in the 70s. So we remember stagflation for all its inherently negative things, because if you lived in America, you invested most of your money in America. Today, there are other places to invest money. There are whole new sectors of business to invest money. And I think that flexibility should mean that investors' portfolios could adapt more successfully to higher levels of inflation than they did in the 1970s.
Now, with your thought that the central banks will actually be fighting inflation with the possibility of raising interest rates, tighter policy, can you just comment on what you think what you feel the effect will be on the bond market generally? So we've been mainly talking about equities, but what would be the effect of bonds, the real rate of return going down due to inflation?
Yeah, well, I have something very controversial to say about the bond market, which is that it's not really a market. I know it is the biggest, most liquid, the U.S. Treasury market, biggest, most liquid financial market in the world, but it is 63% owned by governments. Now, whether that's the American government or the Central Bank of America or other central banks, 63% is owned by governments. Over the past 5 years, nearly 78% of all the incremental new bonds issued have been bought by governments. The biggest distortionary effect on the planet today is the forcing of Asian and other central bank savings into the U.S. bond market, and it's holding the bond yield in America at a ridiculously low level. Now, there are some people, and George Soros is one of them in his new book, who suggest that that's unsustainable, that flow of capital into the U.S. Treasury market will have to end, that U.S. interest rates will have to spike upwards, and that will cause a great deflationary risk to the global economy, because your bond market yields would have to go to true market levels. I don't agree with that at all. I believe that the actions of these central bankers and bank treasuries is fairly much on autopilot, that it will continue, that bond yields will be held at absurdly low levels relative to inflation, and that's going to be the future for many, many years to come.
So do you see these governments monetizing their debt when they can't sell it for real rates of return? Is it a monetization effect worldwide?
I think the American government's going to be quite happy. I think they're going to be issuing this debt at the current interest rate, and inflation is going to be higher than the interest rate. I know it's not what Economics 101 teaches you. I realize that the bond yield should be positive in real terms. The yield should be above inflation. But for any government to be borrowing money lower than the rate of inflation, I think is one way of getting out of a hole, which is very, very nice indeed. And I think one of the great surprises over the next several years will be how quiescent, if we can use the maestro's term, quiescent bond yields will be in the face of higher inflation. And that's not a bad way for governments to get out of a hole just by itself.
It seems that from a historical standpoint, U.S. interest rates have been, over the last 200 years on about a 28-year cycle on average. The shortest duration of an interest rate trend was 22, and I think the longest maybe 37 or 38, but the average around 28 years. So we should, just from a historical perspective, be at or near a bottom of an interest rate cycle and be looking at interest rates rising over the next decade or two. What you're saying is that could be held in abeyance because of the central government subsidy, 63% of the bond market being controlled by other governments who are more than happy to scratch each other's backs, as it were, and continue this game forward, keeping interest rates at a low level. Do I understand that right?
Yeah, I think that's absolutely correct. We are in a bear market for bonds, but it could be a very slow one and take a long time. You could be in a bear market for bonds and still have inflation above bond yields, and people will be wondering why it wasn't happening quicker. It could be another conundrum. Anybody who wants to know about this should read The History of Interest Rates by Homer and Scylla, which gives you a very good run-through on the long-term bear market in bonds. I would stress that they can happen very slowly. You'll know that at the end of the Second World War, the yield on treasuries was effectively pegged at 2.5%. One of the great bear markets, which you referred to, didn't really end until 1981. So right through the 50s, yields were going up, but they weren't going up so materially that it was devastating confidence, that it was actually that obvious that we were in a long secular bear market for bonds. So this forced purchasing of the Treasury by foreign central bankers, I think, will just make that bond bear market a very slow burning one, and will surprise many people as to how slowly it happens relative to the rise of inflation.
Well, let me just say this. For any of our listeners who would like a primer on the market history here in the United States of the last 100 years, Anatomy of the Bear is an essential read. I personally would put it in the top 10 of books that I've read, and clearly in the last 5 years, that gives you perspective, not only on the inflection points in the market where things are changing, Russell, as you've said, is a consequence of either inflation or deflation, these being key catalysts, but just some of the sentiment that was experienced at these market bottoms. I think for any student of the market, this is an essential piece in your library, and I'd encourage you to go to Amazon.com. Russell, we would appreciate you joining us today and joining our conversation with our clients. Most insightful.
Okay, thank you.
You've been listening to the McAlvany Weekly Commentary. I'm Kevin Orrick along with David McAlvany. You can visit us anytime at McAlvany.com, McAlvany.com, or any questions that you may have on any of these programs or anything that's said in our written material or on our website, please call us at 800-525-9556.
This has been the McAlvany Weekly Commentary. The views expressed should not be considered to be a solicitation or a recommendation for your investment portfolio. You should consult a professional financial advisor to assess your suitability for risk and investment. Join us again next week for a new edition of the McAlvany Weekly Commentary.